Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and today I'm excited to have Justin Castelli, owner of RL Wealth Management and XYPN Advisory Board member, on the show today. Justin was on your typical succession planning path that all too often happens, unfortunately, didn't work out as hoped. The owner of the firm had a health crisis and thankfully recovered, but came back to the business with different goals than before, which left Justin with a decision to make. He ultimately decided to launch his own firm and has a very unique service model. He calls it a barbell model, and as a fellow CrossFitter, I have to admit I was intrigued. I promise we did not talk too much CrossFit on the show. His barbell model is basically that he has two types of clients, older clients that have wealth and younger clients that don't. He's actually developed two different service models using completely different technologies, which differentiates the two. It creates this step-up process, if you will, for when his quote-unquote smaller clients see their accounts grow, he can graduate them into a more sophisticated service model using more sophisticated technology. I've never heard of a setup quite like his. I think you'll enjoy hearing about it. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/118. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. It's the community of advisors we've all been looking for that's there to provide support when we need it the most. Best of all, it's free. I encourage you to check it out. Again, that's xyplanningnetwork.com/VIP. Without further ado, here's my interview with Justin. Hey, Justin, welcome to the show, man. Thanks so much for being on.
Hey, Alan. Thanks for having me on.
I'm really excited because we actually were able to have a conversation at XYPN 17 just a couple of weeks ago, and I guess it'll be almost a month by the time this recording goes live. And you're one of our newest advisory board members, which thank you for being willing to take the time and energy to commit to that. But your business is in a really cool place, and you've been doing some really awesome stuff that I wasn't aware of until we had started chatting. So I'm excited to learn more about your business and see what insights you have to share with new firm owners.
I'm excited to share, and thank you for thinking what I'm doing is exciting. And as far as the advisory committee, I'm excited to be a part of it. For me, I want to try to be able to make an impact and move the movement forward. And I think this is one of the ways I can help do that. So I'm excited. Plus, I get to work with you and Michael, which is awesome in itself. So I'm excited about it.
We'll see if you say the same thing when you're done with it. I don't know. We'll have to ask our departing board members if it's as cool as it sounds. So just could you give listeners just sort of an overview of your business, sort of where things stand today, where you're located, number of clients, just sort of a broad stroke, and then we'll dig into the details as we go.
Sure. My firm is RL Wealth Management, and I'll actually be doing a rebrand sometime next year. My wife is pregnant with our third, and she's due on Halloween, and the R and the L in the firm are after my two sons, Roman and Leo. So the third son will have his initial added to the company name. So I will be rebranding next year, but I started the firm technically July of 2015. May is when I started the process. July 3rd, I'll never forget, I got the email from the state of Indiana saying that I was approved to do business. So a little over 2 years in existence. I currently have just under 70 households. That's kind of how I view my client base, is by the household. I started with less than 30. So I was fortunate enough that the previous firm I left, everything ended on good terms. So I was exempt from my non-compete as far as the clients that were mine, and I took them with me to start the firm. So a little under 70 households. I manage just over 20 million in AUM right now, but that should be growing pretty quickly here in the next couple of weeks as some things come through. And I have what I think is a unique approach in that I explain it as a barbell, which is perfect because I'm big into working out and CrossFit. So the barbell analogy is perfect for my likes. But the majority of my 30 clients that came with me initially were baby boomers operating under the traditional AUM model. But one of the reasons I started my firm and left my previous firm was to work with millennials and the XY generation. So I have now, after this last week, it's 29 clients on my subscription model, which are all millennials. So I kind of have both ends of the spectrum when it comes to clients and phases of life and career. And what I'm excited about doing, and I'm sure we'll get into more, is creating a transition from that subscription to the AUM. And my goal is to be with my clients from the beginning of their financial planning until the end and kind of build out my business to be able to do that rather than just service them while they're young and not have somewhere for them to go when things get more complicated.
That is awesome. I had no idea you were a CrossFitter, so now this is just going to turn into a CrossFit conversation. So I apologize to all the listeners that aren't in our little cult.
Yeah, we just lost our audience.
Everybody hears CrossFit like, nope, gone. No one has a CrossFit niche. I just feel like someone out there should just like niche into CrossFitters because there's nothing better than being able to compare financial planning to doing Fran. I don't know. It just seems...
And to be honest, when thinking about niches, I actually explored that and thought about it for multiple reasons. One, I don't really care about golfing, so that doesn't matter to me. If I could meet clients for a workout and then go finish the conversation over, a protein shake or something, that would be awesome. But if we take a step back from a business planning standpoint, if you think about CrossFit, and if anybody out there does it, it's an expensive hobby. So the likelihood of those people being in a position where they could benefit from some financial planning, I think is pretty high. I mean, you're always going to have those outliers that are real young and they're still eating ramen noodles and living the college life and all their money goes to working out. But a lot of the people, at least that I work out with, they're all career driven, they're all business people, and they've got disposable income that planning may be a part of it. So I honestly think you could make a niche out of it.
I agree. Like to your point, like I always felt like if someone was willing to invest $200 a month into their physical health, they were probably willing to invest $200 a month into their financial health.
Right.
Not always, it's certainly not always going to be the case, but CrossFit's definitely a upper middle class workout group just because it is, $150, $200 a month, depending on where you live. So for anybody out there looking for a cool group to work with, there you go. Mm-hmm. So just to take a step back, tell me a little bit about how you got into financial planning. Has this always been your career or did you discover it later on?
This is always where I've been, but it's been in different types of businesses, if you will. So when I went to college, my original game plan was to go to law school. So I majored in econ, had the business background, but I was going to go to law school. And then I met who is now my wife the summer before my senior year and realized that there was something special about her and I didn't want to go to school 3 more years. So I kind of went back to the drawing board about what am I going to do? What am I interested in? And my dad hooked me up with a bunch of guys in different areas of business, and I kept on meeting with financial advisors, and I really was attracted to kind of the strategy of figuring out what's best for each client. No plan is going to have the same recommendations. The relationship aspect of meeting with people and working with them, I really liked that. So about 6 months after I graduated, I started working at a firm in town that we were financial advisors, but we were insurance salesmen. And I quickly learned that that's not the route that I wanted to go, that I liked the planning, I liked meeting with people, but I didn't like life insurance as the main vehicle of recommendations. So I was there about a year. Then I went to a Chase Bank for a year and absolutely hated that experience. I just didn't like being enclosed in the office. And then I spent the greater part of my career at this point. I'm 35, so I graduated in 2004. So I'll be coming up on 13 years in the industry, which is just crazy. I spent about 7 years working for a company that did 403B plans for schools around the greater Indianapolis. That's one of the things I forgot early on. I'm based out of Fishers, Indiana, which is a suburb of Indianapolis. So I had 9 school corporations that we had their 403Bs. Teachers had a reason to meet with me, and my plan was always to take that, and that's how I was going to build the beginning of what would eventually be my business on my own. I knew I always wanted to go the independent route, but I'm not a very aggressive person when it comes to getting clients. So it was a very passive way for me to meet people, find out if they had a need, begin to build that relationship. So I got my CFP while I was with that company, learned the business, built relationships, and I had intended on leaving there to start my own company. And then I met an advisor 3 months prior to me leaving and kind of took a detour to go work at her firm, thinking about a succession plan opportunity. And after being there a couple of years, just realized that that's not where I was supposed to be. And the biggest reason was I was having to turn away clients because they didn't have enough assets to manage to work at the firm. So luckily, her and I ended on good terms. We talked about it. We were both on the same page that I was going to be happier and better suited to be out on my own and kind of go. So that's how I got to where I'm at. So I've always been in the business, started the insurance side where a lot of people start, and then transition to the independent side, and now just fee only and have my own RIA.
That is awesome. And you have the CFP. At what point in that process did you actually study for and sit for the CFP?
I got my CFP back in 2011. So I was at 2 firms prior to where I am today for about maybe 4 years when I started, and they reimbursed you for it. The main reason I got it was I knew this was going to be my career. I love what I do. At the time, I didn't love where I was, but I knew I was going to be a financial advisor. And I'm blessed with looking younger than I am, if that's not too selfish of a thing to say, but that can also be a bad thing at times. So I figured that I can't grow a mustache, I can't grow a beard, I don't have gray hair. If I have my CFP designation, then that'll help bring some credibility as I'm meeting people that they can see I'm serious about this. I'm not just some young 403B kid who's going to be leaving. So I got that about 4 years into the 403B company.
And then you also have the CIMA designation. So did that come after the CFP?
That came after the CFP, and that came as I was leaving to go to the other independent firm I worked for, so at the tail end of my 403B career. And the reason I got that was I love planning, I love the strategy, I love sitting down with somebody and figuring out where we're going to go. And once the plan is completed and started to be implemented, I love the investment side of the business. And I wanted to convey to clients that I understand investments, I enjoy it, I love the course load of it as well. So the actual learning part was fun for me, which is a nerdy thing to say, but I really enjoyed learning about portfolio construction. I spent a week up at the downtown branch of the University of Chicago doing the coursework. So that was later, but that was just to convey that if somebody saw my name on paper, all right, this guy's a planner and he also handles investments, and that's what I wanted somebody on a quick glance to be able to tell.
Yeah, so talk to me about the CIMA, because I believe actually Kitsis teaches some of the CIMA classes, but it's Certified Investment Management Analyst, which is sort of I guess in parallel with the CFA, but different. So I guess why not the CFA, since that's sort of the gold standard for, investments historically. So why not go that route? And I guess, can you just sort of give me and give listeners sort of an overview of the CIMA? Because it's not, I don't think we've ever had anybody on the show that has that designation.
Sure. So IMCA, the company that is in charge of CIMA, is probably not going to like that I say this, but I would say the CIMA is a step below than the CFA. And I think the biggest reason for that is the CFA, I think, has been around longer. I think it's a little bit higher, held in higher regards, but it's also harder. So, but they're investment related, but they're different approaches. So the reason I didn't go for the CFA, in hindsight, I kind of wish I would have, because I was before my oldest was very young. I could have dedicated the time. But I view the CFA as more, if you're going to be a stock picker and you're going to use fundamental analysis, looking at the balance sheets to make portfolio recommendations, I think the CFA is the route to go. As much as I like following individual stocks, I don't really do it with clients. I don't plan on doing that. And at the time, I couldn't. So the CFA was overkill for what I needed, and it would take up a lot of time that I didn't see the benefit. Whereas the CIMA is more about building portfolios. So it's taking mutual funds and trying to build efficient portfolios, looking at, model portfolio theory, Sharpe ratio, all that to build a portfolio of funds. And that was more in line with what I knew I would eventually be doing. At the last 2 firms, I didn't have discretion over client accounts. We had third-party managers to do investments, and then the owner of the firm I last worked at, she did the investment management. So I knew that when I was going to be on my own, I wanted to build the portfolios out, and I thought that the education part of CIMA helped out with that, and also that kind of displayed more of the type of investment manager that I do, that I'm more portfolio construction using funds as opposed to stock selection to build a portfolio.
Okay, that was always my impression too, whereas more CFA was individual securities and the CIMA was more of a fund selection, manager selection, which for most, especially in this day and age, as things are shifting away from active and towards more passive and just the use of funds and that sort of thing, it seems like that's the direction it's going. And I think the CIMA is growing pretty rapidly, so which is very cool. So You mentioned that at your last firm, you sort of went in as a succession plan, and ultimately that didn't work out. But I guess what was sort of the plan? What was the conversation around that and sort of the direction you thought it was going? And was it really just that you weren't able to work with younger clients? Was that really the rub, that you just couldn't find a way to make that work inside that structure?
It was a combination of things. So initially when I met the owner, I told her of my plan of going out on my own, and she was at a point where she was looking to start thinking succession planning. And there was another advisor that had been with her for a long time, but she was more of an operations and relationship advisor. She really wasn't somebody who was going to go out and bring in new clients. So the game plan was, over time, the owner of the firm and I would start to change roles. So she would kind of remove herself from, I won't say the face of the firm, but she always used the term rainmaker, which I hate that term, but she was the rainmaker, and then I would eventually replace her, and she would kind of not fade back, but remove herself, and then I would be more the person that was getting clients, and then the other advisor, myself, would just run the business like it always had been run. And a few months in, she found out that she was sick and had ovarian cancer. I mean, luckily everything was fine. They found it very early, but she spent almost 9 months in Boston getting treatment. So that kind of derailed my development working alongside her and behind her. And the other advisor and I kept things going, and it was a good learning experience. But when she came back, I don't know if it was she got a burst of energy or refocused, but she kind of wasn't ready to continue stepping back. And then I was just kind of left in limbo, in that I was handling investment research, but I wasn't really learning from her. I wasn't really getting to meet her connections in the community to kind of take over for her one day. And I would sit in meetings for an hour and a half and talk for maybe 3 or 4 minutes, and that was it. So I became a little frustrated that I wasn't developing the path that I wanted to. I didn't feel like I was becoming a better advisor. And then I was still meeting with my clients that I had, and I would get referrals. When I brought my clients with me, I made the deal that I understand that my clients don't meet the minimum of that firm, but here are a core group of people that I am their financial advisor, and I want to give them the opportunity for us to continue to work, because I don't want to abandon them when they're going into retirement. This is the worst time for them to have to find a new advisor. I said, if they choose not to work with me because I moved, then that's a choice that they made, and I'm okay with that, but I'm not going to abandon these people at the most critical time of their planning. So she was okay with that, but naturally these clients were referring me to clients in similar situations, and I wasn't really in a position to bring on those clients at that time. In addition, I was kind of coming up, and I hadn't found XYPN at the time, but I just had kind of come up with an idea of, here's a way that maybe I could work with younger clients. And maybe I indirectly read something about the mission of XY and the subscription model, and that didn't realize it at the time. But I kind of came up with a subscription model idea, and I presented it, and it wasn't received with open arms. So then that's when we kind of talked about me leaving and doing my own thing. So it was a combination of having to turn away people I viewed to be good clients, and then not being able to pursue the network of people that were just natural to me, which was my generation.
Right. No, that makes perfect sense. And that's, it sounds like your transition process was a little more seamless, which I want to talk to you about how all that looked. But I think that's, it's one of the biggest reasons why folks ultimately end up starting their own firm with XY. I mean, either one, they really want to be the lead advisor, and they want to take on that larger role. And it's just a slow process inside of existing firms to make that handoff, unless they're just growing really fast. But it's just this desire to work with younger clients. And it's hard. We got into this business to help people, and it's hard to tell someone, I'm sorry, you're not rich enough for me to help. And it's not that they're not actually rich enough. It's that we haven't historically used a service model that allowed us to work with them. I mean, they can pay you $100 a month, but we just weren't providing that for whatever reason. So,
well, not only that, on the AUM side, these clients that were being referred to me were older, and they would have maybe $300,000 or $400,000 of assets to manage, which I don't think is a small account. But when you have kind of an unwritten minimum of $1 million and people fall below that, what you kind of miss out on are these clients were teachers. So they're conservative in nature. We live in Indiana, which has very affordable cost of living. They live well below their means, and they haven't made a lot of money, but they've accumulated a decent amount of assets, and they have pensions. So although these clients don't have a lot of assets, and the view was they're more risky because they don't have as much, they're going to run out of money in retirement. They don't need very much. I mean, these clients, I've been working with them for over 10 years now, and they're pushing 70 and they've never taken any money out of their accounts. Now we're looking at RMDs. And it's because they have a pension, they have 2 Social Securities, they have no debt, they have low expenses because they live in small towns outside of Indianapolis. Like I think those are great clients from a financial planning standpoint, because you're not having to worry about them overspending and blowing up their own plan because they're used to having a lot of money while they were working. So yes, a client may have $3 million, but they may be used to living off of $250,000 a year. I'd rather take a client that has $300,000 or $400,000 in assets, has a pension, and only needs $3,000 a month of living expenses. So I think that when you go into it and say, I need X amount of assets, you miss out on great clients that are great planning clients, because you miss that situation that I've found, and they just happen to be a lot of teachers because that's where I came from.
Yeah, and like you said, really what you need to do is look at how much money do you need to make per client to run a profitable business. That's that's perfectly fine. We rip on asset minimum simply because it's this arbitrary number that we've sort of come up with, but like you need to make a certain amount of money per client, and just in many ways, it sort of breaks down to how many hours are you going to spend per client, how much money do you want to make, and you come up with that number. And if you're working with clients that make $300,000 or that have $300,000 in the bank, and you say, well, I need to make $4,000 per client, charge them $100 a month, because they have a pension. Like they can pay you $100 a month out of cash flow in order to fund the financial planning, if that's what it takes. Mm-hmm. If that 1% of AUM isn't quite enough. So it's interesting how, I don't know, it's fascinating to me that we've just been so obsessed with only charging on assets that we've never really had that conversation around charging on income, obviously, until we started pushing that a little harder. And people still think we're crazy. Like, let's be honest, listeners may think that this is like commonplace, but people still think we're insane for having this bit of the conversation. So I'm interested in hearing about the transition of going out on your own. So you've been working underneath someone, you have some of these clients. I guess when you were at the firm, how was it determined that a client was yours and you were the lead advisor and that sort of thing? Were they clients that you brought in, or just clients that had been assigned to you?
It was basically the clients that I brought over were mine. And then the way that we viewed everything is technically all the clients were clients of the firm. So I was paid a salary rather than being paid based off the revenue that I brought in per client, which going into it I was fine, because I knew at some point I was going to become an owner in this, and then the salary portion would go away, and that's where I would reap the rewards of my hard work. Hindsight, I should have not gotten into an agreement that way, but I was excited about the opportunity, a little naive also. You learn from your mistakes. But so clients that were mine that I brought over, those were mine, and then everybody else was, if I brought anybody else in, technically they would be clients of the firm. But if I brought anybody in and slipped them in, they would have been below minimums anyway. So it wasn't like it was a client that the firm really wanted to keep. So that was easy for the transition. Going into my last day there, I didn't wait until the last minute to determine everything. So I had a feeling that the direction that I ended up going was where the relationship was heading at that firm. So about 3 months prior to me even leaving, I had already reached out to TD Ameritrade to learn more about using them as a custodian. I'd already looked into using e-money. I had everything about the firm determined way in advance, which is what I would recommend it under any circumstance. But my final day came up a little bit quicker than I thought. There was a little bit of a surprise that day I went in was going to be my last day, but we knew that was going to happen. So the only thing I didn't have figured out was the company name. And actually, one of the names I liked is what I branded the subscription model for my clients, because I surveyed some people and they said it was too techy and people may not know what it is that you do. So the night that was my last day, I decided that I was just going to name it RL after the boys. I didn't want it to be Castelli Wealth Management, and I didn't have anything else in mind. I needed to get the ball rolling, and I named it after the boys.
So what is the name of your subscription service?
I call it Wealth Fusion. And my thought process behind it was this firm although I was going to work with my baby boomer clients, I still wanted to really focus on the younger clients. And in order to accumulate wealth, you have to fuse many different aspects of your financial picture. So I thought wealth fusion sounded cool. The fusion of different areas in financial planning to create wealth. I really liked the name, but actually I think it fits better as my subscription model program and the name that I chose for the firm I like. So it all worked out.
So you mentioned that you sort of regret the way that you structured your compensation package. And I think that this is a struggle for a lot of young planners at the previous firm. Mm-hmm. And because a lot of folks are walking into this sort of promise of ownership and succession and all of that. And so often it's not signed. So It's obviously different if somebody's willing to put something on paper. But if they're not willing to put on paper, how do you think you would have preferred, if you could go back and like make a recommendation to yourself then on the type of compensation package and sort of overall structure to negotiate, how do you think you would have restructured that?
I would have been fine with there being a salary component to it because I was doing other things than just meeting with clients. But I would have structured it that the clients that I brought in, revenue that came from them, I would get the majority of that as far as as additional compensation. So I would have a base, and then the revenue that was generated from those clients because they were mine would have come to me. Because one of my biggest frustrations was I took the salary and then I was no longer in control of increasing my income. I was at the owner's discretion as to when I would get a raise and if I would ever get a raise. And I also would have had more of a plan of here's how the progression is going to go as far as the succession planning. Like there was nothing, it was all conversational and going back to being naive. And sometimes I trust people too much to just, go with their word, that I just was, okay, that sounds good. And you want to be out in 5 or 6 years, we'll start this progression. In 3 or 4 years, we'll start the buyout process. But there was nothing on paper. So I would say if you're going to go into a succession, have something written. And I don't think that my previous boss did that intentionally. Sure. I just think that it was an oversight on both parts. And what we know of the industry is most advisors later in their career don't have any succession planning on paper, and they're learning it at the same point that a younger advisor coming into it is learning it as well. So I just think it was not going through the process before on both parts, being excited about the opportunity and just kind of rushing into things.
You make a great point. And sometimes I rip on, well, not sometimes, a lot of times I rip on the older advisors for the failed succession plans and unwritten succession plans. But it's an important note that I agree. I don't think they're doing it maliciously. I don't think anyone that I'm aware of is walking in like, how do I screw over Justin and
right.
Just get as much out of him as I can for the next 24 months. Like, nothing like that. It's just, it's a commitment that we make kind of flippantly and then later on sort of realize what we've done. So it's a great point that if you're going to be doing business development because you want to be incentivized to help grow the firm, but you don't have equity or an actual commitment of equity that, being able to get a percentage of revenue of the business that you're bringing in is a reasonable ask, sort of base plus gross. So that's a really cool way of doing it.
Another thing I would add to that is not from the compensation standpoint, but I think that if you're going into a succession plan opportunity, I think you have to take a step back from the excitement and be honest with yourself about, is it really a good fit? And obviously hindsight's 20/20, but as I look back, I should have seen red flags that said, maybe this isn't the right place for you to be. Like going into it, I knew there was a minimum of AUM to work with a firm. And in my mind, I thought, well, I'll show that I'm a hard worker and that I do a good job and that the clients that I'm bringing with me and people like them were actually good clients, and I'll convince the owner to see my way and change her. And you're not going to change somebody who's been in the business and has been successful for a very long time. You're not going to change their mind. So I think from the young advisor standpoint, you really need to take a step back after and kind of let some dust settle before you finalize your decision and say, is this really where I'm going to be happy? So one of the best things to come out of my 2 years at that firm was I really learned about the type of advisor that I want to be. And that sounds very, cliche or very it sounds silly, but I think it's important. So I knew that when I started my company, I wanted to set things up so I never had to tell somebody no if I thought I could help them and they were people that I wanted to help. And then on the other side of things, I think if you're an older advisor who happens to be listening to this podcast, one, commend yourself for listening to new ways of doing things, but you also need to be open to new ideas coming in from a younger advisor, because there are a lot of smart young advisors out there that kind of have the vision of where I think the industry is going to be going, and it's not the way the older advisors have done it. So I think being willing to compromise and say, okay, we can add this other division so that while we do this succession planning, the clients that are here are taken care of, but the future of the firm is in good hands because we're adapting with the direction of the company. Or not the adoption of the direction of the industry. Sorry, not the company.
Yeah. No, it's absolutely true. And that's, anytime I talk to advisors that are, or I shouldn't say advisors, folks that are sort of supporting the advice industry or the profession, every one of them is asking this question around, like, what is this thing going to look like in 5 years or 10 years? And I can't say that it's going to look the same. I don't think it will. I think XY Planning Network members I think the model that y'all are using is ultimately going to be what the profession looks like, because it just helps so many more people. It just opens up so many new marketplaces when you can charge on income instead of assets, or a combination of both, that, ultimately only about 5% of Americans can actually, pay us 1% of AUM and have $500,000 or more in investable assets that's liquid and available for, an advisor to manage, because that's
right.
A really specific marketplace. So no, I totally agree. So as you were getting your business started, you already had some clients. So how did you transition them over? I guess what was sort of the conversation with them on why you were going to be starting a new business and all of that?
So the day after I left, I called all of my clients, and the previous firm was going to send out a letter letting them know that I was no longer there, but that their accounts were fine. So I called everybody and just said, hey, the previous owner and I came to a mutual agreement that it was time for me to go out on my own and do my own thing. And my clients knew that was my plan before I joined that firm. They weren't totally surprised to see me going fully on my own. But I wanted to get ahead of them getting the letter, because change, especially for older clients, if we're going to stereotype, is not always the easiest thing. And when it deals with your money and it's unexpected, I didn't want them to panic and worry. I wanted them to know that this was mutual and that I had already been planning for it anyway. So I called everybody, and then the following week I just met with everybody for coffee and kind of just shared with them the conversation and the reason why that, I had to turn away some of their referrals because of asset levels, and that I didn't like doing that. There were some things I wanted to do differently, and I wanted to also be able to work with younger clients, and it just made sense for me to go do my own thing and kind of just let them know, here's what the process is going to be, that everything now is with the state of Indiana for registration. At some point, they'll approve me. We'll get together. We'll do paperwork, get everything transferred, and then we're back to normal business. So it really was smooth. Of the whole process, I lost one client out of it. And unbeknownst to me and seeing out these clients, the prestige of the firm that I was at was something that they liked. And I didn't know that about them prior. But as I got deeper into their planning, I could see this, because they were former teachers, and if you were to see them in the school, you wouldn't know, A, they had the wealth that they had, and also that they had these little prestigious factors about them that is kind of in their personal life. And then I had one other client that it took maybe 7 months before they followed over, and it was more about, I just caught them at a bad time, letting them know the transition, and they liked the other advisor there, and they told me from the beginning, we will eventually be there with you, but we just need to process this, and we're not ready to make a change yet. And then eventually they came over. So I think that losing one client in the transition, they say every time you make a move, you lose a certain percentage of clients.
Yeah.
I was happy with that.
Yeah, that's pretty incredible. It's like 97% of clients went with you. I think normally it's sort of tilted the other way. So talk to me a little bit about the structure of your planning process and if it's evolved over time, just in terms of sort of the process and the fee structure that you're using now with new clients.
Sure. So I mentioned I have kind of that barbell business model. I need to think of a better term. I call them, they're basically products. I have one product for my younger clients. I have one product for my baby boomer clients. So the subscription model, the Wealth Fusion plan, I use different technology planning, portfolio management than I do with my baby boomer clients. So,
oh, wow. So totally different tech platforms.
Yeah. So, and the reason I did that was, initially it wasn't that way, but as I began to see my firm evolve and kind of where I wanted to go, what I wanted people to experience is eventually you're going to graduate to needing more in-depth planning. So on subscription model, we meet once a year in person or virtually, because I have clients outside of Indiana, to update the plan and do recommendations for the upcoming year. So we do the long-term plan, but the recommendations I give are for the next year, and they're broken up over time periods of however long it needs to be. So we meet once a year in person. They have access to me as much as they need via phone or email. No one's abused that. And then if there's a life-changing event, change a job, child being born, then we can have another meeting. So it's not limited to just one, but if everything's going as planned, we meet once a year. I send emails and newsletters out throughout the year. There is a client portal that they'll use that's different from my AUM clients. I'm starting to use Orange, and I chose that because it uses a kind of goal tracking rather than just being all about portfolio construction. So it tracks their goals. They can add in their outside accounts. Everything from TD Ameritrade feeds in there if I'm managing their assets. So it's kind of their hub for their finances, but it shows them if they're tracking to the goals. And I thought that was good for younger clients. Portfolio-wise, I just use basically risk-based portfolios of ETFs that trade for no transaction cost at TD Ameritrade. So I use Riskalyze. That score determines which portfolio they go into, and then everybody's kind of using iRebal. I use iRebal to run it and approve the trades. So it's still all about the plan. It's all about long-term planning, but they don't need as much hand-holding of my time when they're younger. When you go to the AUM, which I've kind of just on paper, and I don't know why I picked this number, $350,000 in AUM that I'm personally managing, not your outside 401ks, but if I'm personally managing $350,000, I would move you to the AUM side of things. And when we move to the AUM side of the business, then we're meeting, it's been 3 or 4 times a year, but I think I'm going to condense it down to 2 to 3 times a year, depending on what's going on throughout the year. So we'll meet to do an annual review, update the plan, but we'll have a couple other meetings just to touch base and make sure everything stays up. Because from my finding, when you get to that level of assets, whether you're younger or older, there's more going on in your financial life that it makes sense to get back together more often. But that means you've moved from paying me, $125 a month to potentially $3,500 for the year. So I wanted you to be able to see that not only are you getting more of me, but you're getting a new experience as well. So there's a different client portal. I use Right Capital for the financial planning software because I think it's a little bit more detailed than Advisor, which is what I use for the Wealth Fusion program. And then I use portfolios with dimensional funds and some ETFs in there. And I even have a little bit of a tactical model that I'm rolling out for some clients. So it's a much more in-depth relationship. So I view it as AUM is very detailed, very in-depth, a lot of me. Wealth Fusion is just a scaled-down version. The principles, my views on investing, I build in DFA-like tilts into my portfolios for those Wealth Fusion clients so that it's consistent messaging. It's just presented in different experience for the two models.
This is very unique. We see this with big firms where, they may have like a boomer model and it's totally different. And you sort of end up with a subsidiary that, that serves younger clients and has different stuff. I've never heard of an advisor that has intentionally built out 2 totally different service models with different tech and that sort of thing. Do you think whether there's actual value or not, sort of that aside, because we know there's value over time with planning, do you think you've created in many ways this sort of perception of additional value by moving them from one tech to another when they sort of upgrade into the higher plan? Like it's more than just like, we're going to meet more frequently or, you have more assets, you're more complicated. Like you're legitimately moving them entire platforms. Do you think that gives sort of this additional perception of value?
So I've only had one transition so far, and they haven't said anything about it, but I do think I hope there is. And I'm not doing that just to make it seem as if there's more value. There's a reason for it. Like the Right Capital planning, I think, goes into more detail than I go through in with Advisor. So the planning software is more detailed. I'm using Advise-On for the client portal, which is also my CRM and background stuff. But that portal gives a lot more detail on the portfolio, which at that point, the planning goals and tracking towards those, you're probably pretty close at that point to already have hitting most of your goals. So you're not really focused on, am I trending towards funding college? Am I trending towards funding retirement? You've probably already hit those goals or those milestones. So now you're mostly concerned about your portfolio. And while I don't want my clients looking at it all the time, I want something for them that they can go in and they can get as much information as they need and then ask me questions based off of it. So I do think there's a perceived value in that change, and that it's more detail, it looks fancier, but I genuinely am doing that because I think it's a better, it's more detailed and it's what they need at that point. I don't want to be fake and just make it, I'm going to change you client portal and planning software just to give this facade that we're upgrading you. I really want it to be an upgrade.
Yeah, that's really cool. And, incentives work. And we see this with compensation structures. We see it with different service models and things like that. And there is a psychological aspect to this. I was just curious how that actually plays out. Because again, this is very unique.
Well, one of the reasons it popped up on my radar to approach it this way was as I was telling people my vision before I left the last firm, I had a number of older advisors that I really respect their opinion, kind of say, well, that's great, but these younger clients are going to view you as their advisor for while they're young. And then when they get more complicated needs, they're going to leave and come find me. And I said, well, I can see why you would say that. But one, I think if I provide a good service to them and I do everything I need to do for them, I don't think they're going to leave me just because I'm taking care of them. I think they'll leave if I don't live up to my end of the bargain. But then it got me thinking, well, is there a way that I can show that I have the same services that the older advisor has when they get ready for that? Part of my messaging has really been, when I start to work with clients, especially on the younger end, here's what I'm aiming for. I'm aiming that we're going to work together for the next 25, 30, 40 years, whatever it may be, and that when you're ready to progress to the more complicated needs, I've already got that business model there for you. And hey, and guess what? I've been working with clients in that phase for the last 13 years of my career. So it's not as if I have to learn how do I help somebody in retirement or how do I help somebody in distribution phase. I've already been doing that. And I know what people my age need. So that part of the planning is easy as well. And on top of that, the final benefit is we can take some of the experiences of my younger clients, or my older clients, good and bad, and we can see, looking back, hindsight from them, what are mistakes that they made that we can avoid because we're at the early stage of our career. So I think that just in my mind, I'm really excited about it. And I talked to you about this before. Leaving the conference got me even more excited about building this out this way, because when I would tell people about it, other advisors, they would kind of perk up. And that made me feel like, well, maybe I'm on to something. I'm even more excited. Let's really get this going.
I'm actually shocked that an advisor said that to you about the whole, as your client grows, they'll move on. Mm-hmm. I have felt that advisors felt that way, but I've never had anyone have the gumption to actually tell me that.
He was not doing it to be a jerk. He was doing it in that it was a genuine concern that, hey, I want to see you succeed, and here's what could happen. You could be with these clients for a long time, and they might leave you. And I mean, that advisor works at a firm where their ideal clients 1 to 3 million. So it's kind of the old school thought, and not really seeing the vision of where the industry might be going and what you guys are doing. So I wasn't surprised to hear him say that. I'm glad he did, because it gave me the little bit of extra fire to figure it out.
It's just funny to me because most advisors, especially those that started their own firms 20 and 30 years ago, started with clients just like you have today. Mm-hmm. They started with clients that were lower asset, lower revenue, and they grew with them. And their clients didn't leave for some bigwig firm just because they had a brand name that said, we work with rich people and now you're rich, so come work with us. I think one of the interesting things, we had JD Bruce on the show from Abacus Wealth Partners. And one of the interesting things he said to me was that his clients don't associate themselves with being rich. And I thought that was a really powerful statement, because in financial planning, we try to be like, oh, well, I only work with rich people, but most of our clients don't actually view themselves as rich.
Right.
That didn't even clue in Justin works with little clients and I'm a big client. Now, they don't do that. They look at what is the value that they're providing me? How has he helped me? And in 10 years, when you've helped them transition through all of life's happenings that happen every decade, they're not going anywhere. I mean, you really have to screw it up.
Right.
A firm doesn't have to be a little bit better than you to make that transition. They've got to be significantly better than you. Mm-hmm. So, you mentioned that you walked away from the conference with some ideas. So it sounds like it sounds like even focused more on, or is this sort of a new thing that you're articulating around this barbell concept of transitioning clients? Like, where are you at with that, and sort of what came out of the conference to help you, feel like you can take the next step with that?
So it's not that the barbell is new, because that's what I've been working on building. It's more of committing to, this is going to be my company's brand. This is what my company is going to be known for, is that you can start with me and we can go all the way up to the end. Or if you're in retirement, although I might be writing and blogging towards the younger generation, right now the majority of my clients still are baby boomers. So I can service both ends, and it is possible to work with young and old at the same time. And I wasn't really telling everybody that story until maybe more recently, as I started working with my business coach, Arlene, that just in the short time we've been working together, I've kind of committed to, okay, this is what I'm going to be known for. This is going to be the brand of the company, which gives me more confidence to tell any and everybody about it. Whether it's a client, whether it's another advisor, I don't care if another advisor goes and copies the model. Because the way I look at it is there's plenty of people to help that I can't help everybody. So if another advisor likes the model and they want to kind of put their own spin on it, I think that's great. So it's just been more of, now I'm committed to this, and I'm going to tell any and everybody willing to listen that this is how I work with clients and this is what I'm doing. I haven't gotten to that point with a niche yet, which I know you guys love. I haven't got to the point where here is the people that I am going to work with most often in this business model. It's just here, the business model. So that'll be the next step, but I'm wrestling with doing it. Niches scare me. I want to help people. I don't have a natural niche. Maybe it'll be the CrossFit thing. Who knows? But the biggest takeaway was what I'm doing is a little different and different in a good way, and that I should be proud of it and be wanting to tell any and everybody about it. So that was the biggest takeaway from XYPN 17 on that aspect. The other part was just some things I need to get better about being a business owner.
So where do you see your firm going? Sort of what is your goal? Do you want to be just a super successful, efficient solo? Do you see yourself bringing on additional advisors? Because right now it's just you. Is that correct?
Yeah, it's just me. So this was part of my last business coaching meeting. I want to kind of I want the lifestyle practice, but I don't necessarily want to commit to capping number of clients or capping growth even. So the way I envision it, hopefully in the next year we'll have a part-time assistant or somebody to help from the administrative standpoint. And then depending on if I continue to see the growth that I'm seeing on the subscription model, maybe having a junior advisor or another advisor to kind of help out with the day-to-day management of that, so I can focus on AUM clients, focus on the model of the Wealth Fusion and still doing the annual meetings, but day-to-day things that come up, have somebody help out with that. And then have more time to do blogging and stuff that I'm using to grow the firm. So I envision having an assistant and maybe one other advisor. I've come up with numbers. I would like to have between 100 and 125 clients that are in the AUM model, and between 125 and 150 clients in the subscription model. And I think that with another advisor and an administrative person, I can easily handle 250 household clients. I don't think that would be hard to do with the way I have things set up. And then that would give me the revenue that I would want to live the lifestyle that I want to live and have the flexibility. I don't necessarily want to take 3 months off every year and travel, but I do have a lot of flexibility, and I want to maintain that without jeopardizing the relationships with the clients.
So do you have a revenue number in mind about sort of where you want to be, or is that not the sort of end-all target?
My revenue goal that streamed to get to the numbers, I backed into it. I want to get to about $750,000 in revenue.
So that's gross revenue?
That's gross, yeah.
Okay, and then what do you think your net, do you know what your net would be if you have a couple of hires in technology and that sort of thing?
Yeah, so my net that would be income for me to provide for my family was like around $300,000 was where I wanted to get to. So from that $750,000, I deducted out expenses for running the business, which right now my business is pretty lean. My fixed costs end up being around $30,000 $5,000 a year. I have an office space that rent is not very much. So everything else is pretty much technology, XY membership, all that type of stuff. So my business expenses are low. I gave myself a big bump in business expenses. I knocked out retirement savings for my wife and myself, and then some other savings, and then taxes. And when I backed all that out, that got me to around that 300,000 number, which is way more than I ever thought I would ever see. But I think it's doable.
Yeah, I always like to ask advisors, like, what are you going to do with all that money? Whenever they talk about making, I want to net $1 million. I'm like, what why?
See, that goes to the lifestyle aspect of it. I don't need to make $1 million. Would it be cool? Yes. Would I turn away the opportunity if it came to fit in with everything? No. But I mean, I don't even really need to make the number that I want to go for. But
right.
I think that I can have a business that helps out a lot of people, that provides me what I need to do for my family, and also gives me the time to, on Thursdays I pick my youngest Leo up from preschool at 2:00 and spend the afternoon with him, and then I go back to work later on because my wife has her own business, so a lot of our evenings are spent together working on our businesses. So I want to have that flexibility, and I don't want to miss concerts, I don't want to miss field trips. So that's, for me, the lifestyle aspect is not so much taking a lot of time to travel, which maybe eventually I would want to be able to do. It's more of, I don't want to miss anything.
Gotcha. No, I totally agree. And it frustrates me. I actually am thinking about doing a blog post on this when people say you can't actually have it all. Like, there was a tweet that went around recently from Mark Zuckerberg's sister, I believe, where she said, this is going to be not the best quote, but it was like, basically business, finances, family, friends, sleep. Like you can only have 3.
So I got an email yesterday. There's a guy that I subscribed to his email list. I'm pulling it up right now. His name's James Clear. And he had one, is the downside of work-life balance. And he had 4. So he used it like a burner on a stove. And it was family, friends, health, and work. And he said that you can really only have 2 to be successful. And like you, I don't agree with that. I think I can have it all. I mean, for the health part of that, and this is getting off the tangent, but is eating healthy. Well, that you have to eat anyways, so making good health decisions. And then I can fit my workouts in early in the morning or later in the evening that doesn't impact my family time. So I think it's possible. I don't think it's easy, but I think it's possible that you can have it all.
I agree. And that's, and I would even add, for a lot of folks, I would add faith to that list that, just because you're working really hard doesn't mean you can't take care of yourself and your family. And the truth is, I don't actually know anyone that can work 100 hours a week or even 80 hours a week. I just don't see it. You're not productive. And I think if you only give yourself 40 hours to get it done, you'll get it done. Mm-hmm. But that's my own bias. But yeah, I think it's so important. And I talk to very few advisors that have a number, and I commend you for having a number. Too often, I think we get caught in, I just want to build a business. And again, like, you can easily build, if you want to make $1 million, you can build a business to make $1 million, but it won't be the business that you want. And it won't be the business that you love. And it is very easy to build the wrong business. All businesses are not created equal. And you have to keep that in your mind of like, what am I shooting for? Where am I going? What type of clients do I want to work with? So that you're happy when you get to that 300,000 number, that you're where you actually want to be.
And coming up with a number was not easy for me. And I just came up with it in the last month. So my business had been around for 2 years, and I just came up with what my number was. And part of it's because of the coaching, but part of the reason I delayed it is I've always been afraid to view clients as numbers. Mm-hmm. So prior to starting my firm, I never had to worry about the business side of things. When I was at the 403B company, there were so many different income revenues coming in that I didn't have to worry about, what did I make per client? It was, my focus was find people who want to work with me, do a real good job for them, and let the money work itself out. And it always did. And then I went to a firm where I had a salary, so I couldn't control that, and I wasn't in control of the business expenses, so that didn't impact me. And then I get on my own. The first year is basically get everybody transitioned, find an office space, get things going. Second year is let's grow a little bit. And then I finally got to the point where, okay, now I need to step back and actually view this and treat this like a business. And Arlene had to push me because I didn't want to talk numbers. Like I just want to do a good job, take good care of people, and let the numbers fall where they may. But at a certain point, you have to at least put some numbers down on paper. So I was able to get to my number without doing I need to make X amount per client. It's just kind of more of, I need the AUM model to be at this level, and that would be probably somewhere between this, 100 and 125 clients. I need the subscription model the way it is today to be around this revenue, so that would be between these clients. And then that was all I needed to do. So I didn't get down to a per client revenue. It was more of a per business model revenue, and then a range of where that would be client-wise.
Yeah, because not all your clients are going to be exactly where they need to be. Maybe you have a sort of a minimum fee level that you need in order to, in order to be sustainable and that sort of thing. But again, I commend you for doing that. And I encourage younger advisors to do this, or I should say younger in your business advisors. You can do this no matter what age, but to really be clear on what you're shooting for and sort of your number. Because ultimately it does matter and it will impact the decisions that you make. So you're 2 years in, everything we've been talking about, you've just been absolutely crushing it. So I guess to show sort of the other side of it, because I know it hasn't been all rainbows and unicorns, I guess what have been some of the big struggles that you've experienced or missteps that you've made, as you've gotten the firm launched and to this point?
Knock on wood, I haven't really had any big struggles. I had revenue when I started, so it wasn't like I was struggling to provide for my family. So I think that's probably most people's concern going out on their own. So I avoided that by having clients and having money saved up to get the business started. My biggest struggle is just running a business. I'm not uber detail when it comes to doing my QuickBooks every Friday. And doing all those back things that you need to do for the business side of things, but they don't equate to revenue and it's not bettering your clients. So that's been my biggest struggle, is getting the discipline to do the things that I need to do to keep my business running so that I don't have a big oh crap moment when I get my letter from the state of Indiana that they're going to do an audit. So making sure that I upload and scan all the files into my client files the day I do it, rather than for the first 6 months, I just had a folder in my CRM that all the files went into. So if I needed to find them, I could find them, but they weren't in the appropriate client folder. So probably not the most compliant way to do things, but I met the minimums in that I had everything scanned in. It was all encrypted, but I needed to move it to the client file. So it's just, that's been my biggest struggle is, I'm a planner. I'm a people person, so I want to be with my clients. I want to be doing planning. I want to be researching investments and following that stuff. I don't really want to do compliance checks. And that's why eventually I'll hire somebody to take care of that stuff for me. But I just needed to get the business to a certain point where I could get personal income where I needed it to be, build back the savings that I drew down upon to get the business started. And now I'm at that point where it's starting to be where I can start to think about hiring somebody in a part-time status. So the biggest one is just running a business. And some people are going to be better at it than others. Some of us as advisors are better number crunchers, and it's the people side of things that they struggle with. Again, knocking on wood, I haven't had any issue growing my clients. I haven't really done a lot of outbound marketing other than I have my blog, and that's brought in some clients. The XY Planning Network Funded Advisors brought a few clients in, but it's really been a lot of referrals and word of mouth. So I haven't had to struggle to find clients, which I'm very fortunate for. And I know that not everybody has that same opportunity, but it's been the business side. It hasn't been the financial planning. It hasn't been the client acquisition. It's just running a business.
Yeah, it's a hard lesson to learn. I mean, you can't learn how to run a business till you run a business,
right.
And it's just part of it. And I wish there was a shortcut, but there's really not. It's just experience. Mm-hmm. And the business that you learn how to run today won't be the same business that you're running in 5 years. It'll be a different business, a different skill set. And you just have to always be growing and evolving and I guess focusing on becoming a better business owner and a better manager, because no one is born innately just like gifted at running a business. Like you may be a great problem solver or whatnot, but it's a skill set that you have to hone. And, in many ways, it's almost an art form that you have to develop. Mm-hmm. So, as we're coming to a close, if there's one piece of advice that you wish you could go back and give your younger self, mm-hmm. maybe this is the Justin that's splitting out on your own or maybe before then, what do you think that one piece of advice would be?
Good question. I'm going to go back to myself prior to going out on my own, and I would tell myself to do it sooner. And I think that's something that a lot of business owners end up saying is, I wish I would have done it sooner. And like I mentioned, I learned a lot while I was at the previous firm, but I'm so much happier now on my own, and I'm enjoying my job even more, that I wish I just would have done it sooner. I mean, my family life didn't suffer during that time period. I wasn't depressed or unhappy, but I enjoy everything so much more. I have a lot of pride in what I'm doing and where I work, that it just makes you feel good about continuing to do it. So I would say do it sooner. If you're thinking about it, get everything lined up. It's always going to be a leap of faith. So what I told my wife when I wanted to do this originally was, it's going to be a leap of faith. But if I can do everything in my power to shorten that leap by taking good care of my clients and knowing that I have clients to follow me and projecting out what expenses would be and having money saved, that if I can shorten that leap, then my chance at making it to the other side successfully are going to go up. So I don't think you should just get fed up one day and go leave. But if you really, at the end of the day, know you want to be on your own, start figuring everything out so that when it's time to go, you're ready.
I think that's awesome advice. Well, Justin, thank you so much for taking the time to come on the show and share what you're working on. I'm so excited to see your future, and I suspect it will not be long before you're hitting that 300 net number that you're looking to get to. So thanks again for taking the time.
Oh, thanks for having me. It's been awesome, and I was humbled that I got to come on. So thank you for having me on.
Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitsis, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.